Why pay more for your precious metals from the big guys with offices on Wall Street and who bank with JP Morgan? From the basics like eagles, maples, rounds, and bars, to collector coins like the Silver Shield and Heroes SD War Collection, to our exclusive line of insurance-approved, TL-rated precious metal safes, SD Bullion has what you're looking for at the lowest prices, period. Guaranteed. Find out why over 15,000 new customers have recently made the switch to buying their gold and silver from the dock. Give our team an opportunity to earn your business today at SD Bullion. Why pay more? This is the Doc and Eric Dubin with the SD Weekly Metals and Markets Wrap. Joining us this week is a special guest returning to the show. We have James Turk, the founder of Gold Money and the co-author of The Money Bubble, What to Do Before It Pops. So James, it's great to have you back on the show.
Thanks, guys. It's great to be with you.
Well, we were just chatting before the show started here. It's a perfect time to have you back on here with all the action we've seen in the markets the last few weeks. And today we're recording on Thursday the 24th, and the metals have had a nice little pop today. So why don't we start with the action in the metals, and what's your take on what we've seen over the last few weeks, James?
Yeah, I think there are a couple important things, a couple important observations to make. First of all, it's been 4 years since we've had an uptrend in gold. It's been in a sideways correction over the past couple of years, building a base. This is a long time for gold to not have any kind of a meaningful rally. So a meaningful rally is overdue. Secondly, the autumn period going into the first quarter of the new year, that's generally a good time for the precious metals based on historical patterns. Seasonal patterns don't always work, but you do have to look at that, and when they do work, it's good to have the wind in your sails from seasonal factors. But I think the most important thing is, what's going on in the physical market. We've seen that the registered stocks at the COMEX have fallen to near record lows. The metal is being drawn out. We've had backwardation reported by the COMEX. We've had backwardation here in London for quite some time. And that means that the spot price is higher than the future price, and it's an anomaly that should not happen in the gold market and is very rare when it does. So what that's saying to me is that the demand for physical metal is so great that ultimately the price is going to have to rise. And the reason is that you can't create physical metal out of thin air, like you can create national currencies. Physical metal has to come out of the ground, and that's a long and arduous process. You can't increase the amount of physical metal that you're mining by any significant extent, even if you were to high-grade your mines. So the only way the demand for physical metal can be met is that people who own physical metal now have to see a much higher price at which they're prepared to sell their physical metal and hold some national currency instead. And I think that means that to correct some of these imbalances and anomalies that we're seeing in the market, you're going to have a nice big rally going into the end of the year, the first quarter of next year.
Let's talk a little bit about some of those physical tightness and what we're seeing here, both in the retail and the physical market, precious metals here in the U.S. The retail shortage has been well documented, but it's continuing to worsen and exacerbate. Even this week with prices up a bit, and on the retail side, demand has calmed down a bit. The shortage has actually worsened this week. And probably, well, I guess there's a couple of things to note, but one of the most amazing things in my mind is the world's largest silver bullion wholesaler. Their inventory, they're now selling 3 items. They're selling current year silver eagles, shipping the first week of December, and they're selling them on a wholesale level to dealers at $5 over spot. So we're talking a 33% premium on the wholesale level. They're selling silver Philharmonics about 3 to 4 weeks out at nearly $3 over spot in the wholesale level. And they're selling 100 ounce, the new, I think it's Japanese, the Asahi bars that bought out Johnson Matthey. And those are shipping around Thanksgiving. We're talking about the world's largest wholesaler of physical silver. And they're currently selling 3 products, and they're both shipping in anywhere from about 6 to 8 weeks, which is, that's just mind-blowing.
Yeah, it really is. And, the problem with the precious metals markets is they're very opaque. We can't really just get all of the data that we need to do, that we need to look at in order to make a really thorough analysis, and have the bell ringing that this is what it is. So what we have to do is we have to take bits and pieces of what evidence is available, and things like you're reporting is good evidence. Just like we're seeing the backwardation, that's another piece of evidence. And all of this suggests that we're going to have much higher prices in the near future in order to bring the market back into balance, clear some of these anomalies that we're seeing, long lead times for delivery, spot price higher than futures price, the huge premiums that we're seeing on metal, even if somebody's prepared to make an offer on it. These are unusual times, and it's suggesting to me that the price of gold, the price of silver, is way too low.
Well, there's a lot been recently, even people speaking about the prospects of going to COMEX, buying 1,000-ounce bars, taking them to private mints and producing generic rounds just to arbitrage away this gigantic premium that we're seeing. And what's interesting about that is that back in 2011, or I should actually, more apropos, the period 2009, when we went through that crash, some people were trying to do that, but we're in a different stage now because the vaults at the COMEX, LPMA, they just don't have as much metal as was once in our system. And it looks like the thesis that GATA and others have put forward that the physical market will eventually be the Achilles heel of the cartel's ability to continue to do manipulations. And I was wondering if you had a sense as to where we are along that path.
Yeah, first of all, I agree with the premise and the way you've explained it. I think that's exactly right. And talking to the different refiners in Switzerland, the demand in India, the demand in China, even the Middle East, it's voracious. They want physical metal at any price, regardless, what the price is. They just want it. So what's happening is the refiners are looking for physical metal everywhere they can, and they're looking now at the COMEX, which is very, very unusual, because they have to ship the gold bar, the 100-ounce gold bar, or ship the 1,000-ounce silver bar to Switzerland, refine it and fabricate it in the way that the Asians want to purchase that metal, but they're still making a huge profit out of it. It suggests that, again, the physical prices are way too low. Are we near that moment when everything is going to finally break loose or not? I don't know, but I like to compare the present situation to the 1960s. We had this cartel back then called the London Gold Pool. It was a cartel of central banks, and they were trying to keep the gold price at $35 an ounce. And over that period of time, over several years, they just hoarded 10,000 tons of gold out of Fort Knox to try to keep the price of gold at $35 an ounce. And the conventional wisdom became back then that the central banks will succeed in keeping the price at $35 an ounce. And they did until March of 1968, when the central banks realized that they were fighting a losing battle, that the demand for physical was tremendous, and that an ounce of gold was worth more than $35 an ounce. So they threw in the towel, and that unleashed the bull market that took us all the way to 1980 and much higher prices. Now, the similar situation is we have the metals here at $1,100 an ounce. The central banks were throwing everything they could at it. You had this voracious demand coming from all over the world, and as a consequence of that voracious demand, you're probably reaching a stage where we're scraping the bottom of the barrel in terms of the available metal at these prices, and that's why COMEX inventories have been drawn down to the extent that they've been drawn down. The refiners in Switzerland can't get the metal anywhere else, so they're going to go to the COMEX and pull it out. The other point here is that the relationship between the eligible inventories in the COMEX and the registered inventories, if those eligible inventories were really available for sale and distribution and for meeting delivery under the contracts, you would think eligible would be moving into the registered category. And I haven't seen that happening. So as a consequence, so yeah, maybe we are here at that stage where the markets are finally going to start turning, and it's going to be a sustained uptrend, pulling away from this base that they've been building over the last 4 years.
Can you explain the difference between eligible and registered for our listeners? Because some of our listeners will probably not know.
Yeah, the COMEX reports the total inventory, and there are two categories. If it's registered, it's available for delivery, immediate delivery against a contract. If it's eligible, it meets the standards, the chain of integrity that the COMEX sets to make it deliverable. But just because it's eligible, that doesn't necessarily mean it's going to be made registered. And in fact, we're seeing the eligible stocks holding fairly steady, whereas the registered stocks are declining, which suggests to me that the people who own gold and store it within the COMEX system aren't prepared to deliver it, to meet delivery contracts at current prices.
And a lot of people have been trying to rebut the significance of others who are pointing out this discrepancy, and they basically make the argument that, well, the bullion banks like JP Morgan can just switch back and forth at push of a button, and technically that's true, but the take-home point and the market signal intelligence value of what's going on, in my opinion, is that, in fact, the total availability of gold or silver in the system in its entirety is lower. I mean, we're just seeing less physical, period, end of story. So I find it a little bit puzzling how people construct that as an argument in an attempt to poo-poo the significance of what's going on. What's your take on that?
Yeah, there are a lot of apologists for the system out there. And those apologists are going to make all kinds of excuses, and they're going to make all kinds of stories. But, at the end of the day, look at what the numbers show. Look how little metal is available in COMEX. Look at what the refiners are doing in Switzerland and how much metal they're sending over to Asia and to India.
We reported last week about the enormous demand that's coming from Asia, and what seems to be happening now, interestingly enough, is that India is picking up its demand, and for silver as well too. I mean, the amount of silver that India is taking down in imports now is going to put them at a run rate that will probably exceed 10,000 metric tons this year alone. And that's an order of magnitude larger than what they typically have done, say, like 5 years ago or so. So the physical market is definitely beginning to ratchet up demand and quite possibly make the managed retreat process something that the cartel is going to have to embrace and let prices go back up.
Yeah, I agree with you. And, the point you're making about India is very good. I think that's really sort of representative, not just of India, but, the whole world, in the sense that if you can't get the gold, what are you going to do? You're going to buy some silver. I see silver as a gold substitute. In other words, if your dealer doesn't have gold coins, well, buy silver coins, because, right now, 74 silver ounces does the same thing for you that 1 gold ounce does. It gives you money outside the banking system, money without any counterparty risk, and I think that's a key. But, more importantly, perhaps, the historical ratio is 16 ounces of silver to 1 ounce of gold. And as money comes into the precious metals market, you're going to see that gold-silver ratio fall back down. I mean, 4 years ago, at the peak, when we got back up to $50 an ounce, the ratio was 32 ounces to 1. We're 74. A few weeks ago, at the August low, we were 80 ounces of silver to 1 ounce of gold, which is, again, in my view, an anomaly showing that silver is very, very cheap relative to gold. So if gold is cheap at $1,100, silver is even cheaper, at $15. And my expectation would be that with the metals going higher as we go into the autumn period and into the first quarter of next year, silver is going to outperform, meaning that the ratio will go back, will fall back. Whether it's going to go, to 60, 50, 40, or even 30 again, who knows? But, it's going to go in the right direction, meaning that silver is going to outperform.
And guys, I want to take a minute here and just touch briefly on the other side of the equation. I mean, all summer we've been hammering on the demand side and the exponential increase in the investment demand we've seen, particularly in silver, but gold and silver. And I wanted to touch a little bit on the supply side. some really stunning numbers that I just saw this week, and our good friend Steve from SRS Rocco Report published it this week. Australia and Canada combined for the first half of this year, their silver production is down about 30% from the first half of 2014. And we're talking, I think it's about 11 or 12 million ounces just for the first half of the year. So just those two countries, they're on pace to have around 25 million ounces less of silver production in 2015 than they did in 2014. And we're just talking about Australia and Canada. So we're not talking about, it doesn't include the numbers from Mexico, the U.S., South America, Chile, etc. I mean, just as a percentage basis, I mean, we're 28% combined with Australia and Canada. Australia is over 30%. Their production is down this year, and I think that's just another data point that's going to result in what you were just talking about, James.
Yeah, John, that's a very interesting number. A lot of silver is produced as a byproduct to copper. Copper mines produce principally copper, and then they produce silver as a byproduct. That's particularly true in Australia, less so in Canada, but you see it there. You see it in the United States, too. The important point is that with China slowing down and the demand for copper in China less than it had been during the boom years, the Australians and other mines have been slowing down their production of copper, and therefore they're slowing down the production of silver as well. So I guess the numbers that you're quoting are starting to show that slowdown in copper production and less silver being produced as a byproduct to copper, which also has other interesting implications. A lot of people just see silver as an industrial metal, and they say, well, if the economy slows down, nobody's going to want, or silver's going to be impacted negatively by a slowdown in the economy because the industrial demand for silver will decline. But the other thing that you're just pointing is that if the economy slows down, which it is in China and many other countries around the world, the demand for copper is going to decline. Less copper will be produced and less silver is going to be produced. So, these arguments that silver isn't going to do well if the economy doesn't do well, I don't necessarily buy that. And in any case, I really see silver, having two different unique types of demand for it. One is its industrial demand, but the other demand, which is the one we were talking about before, is silver's monetary demand. 74 ounces of silver does the same thing for you that 1 ounce of gold does. And why not buy silver if you think that the ratio, the gold-silver ratio, is going to decline? Because if it does, you're going to, in dollar terms, end up with silver outperforming any appreciation in the gold price.
Investor demand can easily multiply quite significantly as well, too, because in the precious metal space for North America, I mean, it only represents about 1% of assets in financial assets terms. So it wouldn't take that much for, if we had an increase to, 100 basis points, so the demand annually would double. There's not enough metals, gold or silver to supply that demand.
Think about that. We're not talking about a move back to 10 or 25%, just a move from under 1% to 2 or 3%. And the situation would completely change and you would not be able to find an ounce anywhere.
Yeah, and we're almost there now. I mean, there's a lot of products that you just can't find, as you were explaining before. And what's really interesting this time around, as we see these rising deflationary pressures in the asset markets, because, assets are really richly valued, and we've had all this QE from various central banks, and most of that has been driving our stock markets and in the bond markets as well, too, even though, we're nowhere near the lows in interest rate terms that we saw a couple years back. But, 2008, 2009, there was enough metal around to not have a complete breakaway with investment demand, with people seeking a flight to safety in metals, such that we would have seen the cartel completely lose their grip. But this time around, I think it might actually be a little bit different. So the people who are expecting the probability of a deflationary wave hurting silver, pushing it down because people are worried about industrial demand, will probably not be as significant. And it gets back to a lot of the work also that Steve St. Angelo has been doing it, SRS Rocco report. I was wondering
You
what
know,
you
that's
think about the deflationary trend argument and what's going on macroeconomically.
Yeah, that's a good point. You're making. You have to keep in mind as well that 2008 was a liquidity event. Everybody sold what they could in order to get the liquidity they needed to stay afloat. And for a while, gold and silver were sold down until everybody realized, well, the liquidity issues are over. Now we got to worry about counterparty risk. And it became a fear event, and you saw gold and silver rising. This time around, you may not even get a liquidity event. The next Lehman type crisis. It might just automatically be a fear event, and one morning you wake up and you're going to see, gold $50 higher, or even more, and silver maybe $5 higher, or maybe even more, because people are going to be fearful of their money, and they're going to seek assets that don't have counterparty risk, and the most liquid assets that don't have counterparty risk are, of course, gold and silver.
Let's change the focus a little bit here, James, and if you could give the listeners a little bit of an update on BitGold.
Yeah, we've come a long way since we spoke about this a few months ago. The transaction was completed. We now have goldmoney.com and bitgold.com operating as two separate but interrelated divisions within what is now called Gold Money Incorporated. BitGold Inc., which is listed on the Toronto Stock Venture Exchange, changed its name to Gold Money Incorporated. This trading symbol is still the same on the TSXV, the symbol XAU. But we've come a long way in terms of products and things that we're starting to deliver. The most recent one was that we've announced ACH, which is a very easy, simple way to make payments from U.S. banks to purchase gold. Plus, you can do it now on a recurring basis. In other words, if you want a dollar cost average gold, buying $100 at the end of the month for savings, or to save it up for the next 18 years for your young baby's college education, you can set it up so that $100 will be taken out of your bank account on any day of the month and used to purchase gold at 1% over spot, which is very, very attractive. It's one of the least expensive ways to purchase metal, and that metal is stored for you in allocated storage in different, whatever vault you want, in different locations around the world, and there's no storage fee in BitGold. So yeah, we've come a long way. There's a lot more to do. We announced a mobile application for cell phones, both for Android as well as for Apple. Those are up and running, and I use the Apple one a lot. I think it's really a very, very attractive app. So yeah, good progress in both BitGold and Gold Money, and there's still more to come.
How do you see the long-term dynamics with services like BitGold and people using gold as basically you're essentially making it possible to use gold more easily as a currency? Do you think that that's going to be embraced by more and more people over time? And what do you see as the long-term vision for services like BitGold?
Yeah, I really do see it, as making gold more easily to be used. Money can be spent or it can be saved. And right now the tendency is to basically save the precious metals rather than spend it, because it's very hard to spend a gold coin or a silver coin. It happens in a few places in the world, but it's the exception rather than the general rule. Well, the technology is changing everything. They're making it very easy to spend gold through the technology. You can have a mobile phone, and you can very easily click gold from your ownership to whoever you want to pay. The gold immediately becomes owned by that other person. Title transfers instantaneously from the payer to the payee, but the gold stays safe and secure in the vault. And my thinking is that technology does change things over time. Uber is changing the taxi business worldwide. Airbnb is changing the hotel business. And the interesting thing about this, Uber doesn't own a taxi. Airbnb doesn't own a hotel. Yet Airbnb has a bigger market cap than Marriott, which has been around since the 1920s, as just one example. The technology is changing everything, and I think BitGold is going to be at the forefront of that, and that's one of the attractions that we saw merging what we had in gold money and bringing it together with BitGold. Both companies had strengths, and we saw the strengths being complementary to one another. So it was, the sum of the two parts was made a 1 + 1 = 3 situation. The whole was greater than the two parts looked at individually. And I think the technology is going to be the driver. And I would like to see, gold do that because, 5,000 years, gold has been money. It's still money. It just doesn't circulate as currency. What we're doing is we're giving gold, BitGold is giving gold a new usefulness. And, value comes from a thing's usefulness. If we can make gold more useful, that means more people are going to want to own and use gold. And if more people want to own and use gold, that means the gold price relative to national currencies is going to rise.
Yeah, and if you wanted to draw the analogy to its most extreme, if we had gold-backed currencies and gold was basically the basis by which people contracted business relationships and commerce, we would have a heck of a lot higher price in gold because a lot of people always say, we can't have a gold standard because, gold is just, there's not enough money to back currency. That's totally nonsense. It's really just a matter of what pricing it's at relative to the national currencies that are floating against it.
Yeah, that's exactly right. And, the thing is that we do have enough gold, and every year we're adding more gold to this above ground stock of gold. Gold is different from all other commodities, and silver has the same characteristic. But the difference is that all of the gold mined throughout history still exists in its above ground stock. You can't say the same thing for silver. So in that sense, silver is even more rare than gold is. But this above ground stock of gold grows by about 1 3/4% per annum year after year after year, which is approximately equal to world population growth and new wealth creation. So you have this consistency in supply and demand. This above ground stock I call, gold's M3, which is the total quantity of gold money in circulation. And the interesting thing here is that an ounce of gold still buys the same amount of crude oil it did, 50, 60 years ago. And I like to use the example with silver that I remember growing up as a young boy in Ohio in the 1950s, and my parents could drive the family car into the local gas station and fill it up with $2 Well, today, $2 barely buys you won't even buy a gallon of gasoline. But if you take the silver content of $2, you take the value of the silver in those $2, you can still fill up the family car. So just like gold preserves purchasing power over long periods of time, so does silver.
We like having guests that have their business operations and when they live in Europe and they have a pretty good perspective of what's going on in Europe because obviously we know what trends are in the United States, North America overall, given what S&P Bullion sees directly and people we speak to more frequently. So I'm wondering if you see any difference in European demand for bullion right now and customer trends. Is there anything noteworthy that seems to be different in Europe vis-a-vis, say, maybe 3, 6, 12 months ago?
Yeah, the demand in Spain has really picked up. And I don't know whether this is a result of people looking at the Greece situation and wondering whether the Spanish banks are going to make it through. I'm just not sure about that. But there's still a lot of concern here in Europe about the euro and whether it's going to survive. And the whole European Union is being put to a test again because of this migrant crisis. The thousands and thousands of people that are coming from not just Syria, but from all over the world. I've seen reports here in the British papers that only 1 in 5 people coming into Europe are from Syria. The rest are from dozens of different countries. So this is putting the European Union to a test. And of course, you still have the big issue, which are the over-leveraged, too heavily indebted welfare states. They're having a difficult time dealing with all of their debts, and as a consequence, one has to question: is the euro going to survive? These are reasons that people are looking to buy precious metals, diversify their assets outside of euros. And why own a euro anyway? Because you don't earn any interest on it when you put the money in a bank, and then you have the problem. Well, is my bank going to go under, and then I have to deal with bail-ins, like Cyprus, or what's likely to happen in Greece, and may happen in other countries, which is why you're seeing demand for metal in those countries that you at a higher pace than what you maybe saw a couple of years ago.
So what's your outlook overall as far as precious metals are concerned, and maybe even discuss macroeconomic dynamics? I mean, for example, as we spoke before, looking at very high valuations in the stock market. Do you think that we're going to see pressure perhaps in the bond market and stocks also creating safe haven demand for precious metals in the not too distant future?
Yeah, on the short term here, stocks look a little bit shaky, particularly some of the financial stocks. I mean, if you look at the share chart of Deutsche Bank, for example, it looks horrific. And one has to wonder, what's going on inside Deutsche Bank to put the chart looking as bad as it is. But I'm of the view, when you're looking at it from a macro sense, the way this is going to unfold, there will be a collapse, but it's going to be a little bit different. It's going to be a collapse of the dollar. It's not necessarily going to be a stock market collapse. In other words, you'll have the volatility up and down, but if the dollar collapses, you're going to see the stock market in nominal terms go up, but it won't do as well as gold or silver. In other words, you have to look at a place like Weimar Germany or Argentina when they hyperinflated, or Zimbabwe a few years ago. In the late 1990s, as it was hyperinflating, Zimbabwe had the best performing stock market in the world because people would rather own a company that owned assets rather than hold the Zimbabwe currency, because the currency was losing purchasing power. So this is the theme of the book that John Rubino and I wrote, The Money Bubble. The bubble today is not the stock market, it's not the bond market, it's not any other market. The bubble today is what we call money, but really isn't money. It's only a money substitute circulating in place of money. The real money is gold and silver. And as bank problems and government debt problems continue to build and eventually collapse, we had a whiff of that in 2008 with Lehman. As these problems build and collapse, ultimately collapse, you're going to see the currencies collapse. You're going to see the precious metals take off, and in nominal terms, because of the collapsing currency, stock markets might rise with them. So it's a little bit different than what a lot of people are thinking.
Exactly. Yeah, and one of the great points that you made and John made in that book was that hyperinflation events are primarily confidence events. It isn't just that there's too much money chasing a fixed amount of goods. I mean, people's confidence in their currency can change on a dime.
Exactly. And you can see this in a chart that the St. Louis Fed puts out called the velocity of money. It's M2. And M2 has been declining for a couple decades now, and the decline is actually starting to accelerate. Now, what velocity is, it's the total amount of economic activity divided by the total amount of M2, the total quantity of dollars in circulation. And people say, well, dollars have to be spent faster, but it doesn't really mean anything because the equation is essentially goods and services versus dollars. So saying dollars has to be spent faster is like saying goods and services have to be purchased more frequently. By themselves, neither of those two things mean anything. But what that chart is basically saying, as velocity declines, there are too many dollars. There's too much new dollars being created relative to the subdued amount of economic activity that we're seeing in the United States today. And what that's also suggesting from a bigger picture point of view, if there are too many dollars being created, the dollar is being debased, and ultimately the demand for the dollar is going to fall. The dollar has only risen against the euro because the euro has its own problems. Japan has its own problems. It was sort of the choice, being the world's reserve currency. But this is just a temporary aberration, and eventually the dollar is going to decline along with everything else when you measure it the proper way, which of course is measuring it in terms of gold and silver.
Well, before we wrap up the show here, James, if you could let the listeners know where they could find your new book.
Yeah, we're on Amazon. It's co-authored by myself and John Rubino. It's called The Money Bubble, What to Do Before It Pops. And if you want to look at some of the information that we also provide, I suggest you go to goldmoney.com or bitgold.com.
All right, we certainly recommend it, as well as BitGold as definitely an interesting way to store precious metals in an allocated form. Again, we believe that the best way it is to hold it in your own hand, but if you're going to have it stored, it definitely needs to be allocated. So,
yeah, I agree with you on that. Allocated and insured, which is what we do. But let me just make one point on this. I actually believe that you want to have your precious metals diversified as much as possible, as much as practical. And, if you have X amount of gold and silver at home and you're comfortable with that, I think that makes sense. But if you want to buy more gold and silver and you're worried about storing it at home or in your backyard or wherever, then you got to look for professional storage. And when you look for professional storage, you want to make sure it's allocated, you want to make sure it's insured, you want to make sure it's audited. And we do all of those things in both bitgold.com and goldmoney.com. What you don't want to do is you don't want to store your money in a safe deposit box. We saw in Greece, for example, that when the banks closed, people didn't have access to their safe deposit boxes. So what could they do? They were stuck. Never store your precious metals in a bank. You want to store them someplace safe. And banks are not safe places to store precious metals.
Or anything these days.
Yeah. Well, I think your basement is safer than putting it in a bank, to be quite honest.
All right. James Turk of Gold Money. It's great to have you back, James.
Yeah, thanks, guys. It's always great to speak with you.
For the doc, Eric Dubin and James Turk, thanks for tuning into this week's SD Weekly Metals and Markets.